Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. And I'm going to talk about how out of touch I am. So I don't know if you've ever seen the episode of The Simpsons where Homer is explaining to his coworker how he done all these things and he's acting like he's normal. And one of the things he talks about is like, "Oh, I went to space. Didn't you go?" And then it's the same thing that I'm gonna do in this video where it's like, "Oh, I just paid off my mortgage under 3 years," and then I'll act like it's normal. In fact, it's from this clip right here. Let's go ahead and play it.
For the Smashing Pumpkins. Oh, and here's a picture of me in outer space.
You went into outer space. You.
Sure. You've never been?
And that's how I'm gonna act in front of everybody else. Like, "Oh, yeah, I paid off my mortgage under 3 years. You never did that?" So that's what I did right here. So I don't know if you can see this right here. I paid off my mortgage in July 2024. And so to calculate when got my first mortgage payment, you get this, I'm sorry, you get this number right here, 2051, right? 2051. Okay. And all you do is subtract 30 years, right? So 2051 minus 30 years. And so in 2021, that's when I got this first mortgage, November 2021. I paid off in July 29, 2024. Or last, that's when the snapshot was for this mortgage balance statement. You know it's a mortgage because it says conventional no PMI lien position one, and I paid it off. And so now I'm just gonna act like it's all normal and, oh man, it's an everyday thing. You never did that too? You've never been to space? Oh, okay. Well, I'll tell you how I did it. It's called I threw all my money into debt with the help of a line of credit, and that's what velocity banking is. Throwing all your money into debt with the help of a line of credit. So, um, and that's what we're gonna review for today. And that's how you know when you have good problems, like rich people problems, because it's like, yeah, this stuff is so boring, and that's how you know you've mastered something, right? Like you do it over and over again, and you kind of have to appreciate the boredom. And the reason why most people will never master their craft is because they're always looking for novelty, right? And so I know this boring old thing, at least it's boring to me, called velocity banking. And all it is dumping all your money to debt with the help of a line of credit. And so what we're going to do is, well, I already did this, do a budget. Right. And this is actually the last budget that I did. So I'm going to go over the same situation again. 6,900 of income. And if you don't know, $6,000 a month after tax is about $100,000 a year salary. Okay. So we're a little bit over $100,000 a year salary, 6,800 expenses, and we only have $93 left in savings. And if we do expense breakdown, we have two credit cards, we have two auto loans, two student loans, and we got a mortgage. And the whole point of this is to pay off all of our debt. Okay. And we always have to pay for food, gas, insurance, and all the other good stuff. So things that are not debt, I always just kind of put an average on the last line. And so once you've done that, we also have to have access to something called the line of credit. And so what's a line of credit? Well, all it is a financial tool where you could borrow money, pay it back, and then use it over and over again. So for example, if I take a look at here, and you might be wondering what's with the goats. Well, I asked ChatGPT, "Hey, I paid off my mortgage in 2 years and 9 months," and then ChatGPT said, "Oh, only like 1% of people do that." And I said, "Am I the goat?" It's like you are the goat. That's what the goats are for. Greatest of all time. All right. So as you can see here, this is a line of credit, home equity line of credit. And so what does this mean? I could literally go to the bank's website, push a button, and then by pushing a button, I can dump up to $280,000 into my checking account at a 7% interest rate, right? That's all that means. Okay? And so yeah, so we did that or we have access to that. And the cool thing about this is that it's even better than in credit cards in certain ways because I can use it to pay anything, whereas a credit card, I can't use it to pay everything, right? And so I got all the lines of credit that I need, including credit cards. I don't know if you knew that a credit card is a line of credit. And so I have over $575,000 in lines of credit. And so some of you are like, how do you get that much? Is this even real? And I'm going to tell you what I tell you in every single video. And some of you will get sick of it. In fact, I'm getting sick of saying it, but it's the truth. And the truth is that banks don't lend money to people who need it. They don't, right? So if you lend money to people who need it, guess what? You're never going to get it back. And that's what the banks know, that secret. And so what you have to do is you have to get the money before you need it. And this is kind of like a warning to not wait until the last minute to know how to do this strategy. In fact, I learned this strategy when I was making 20 grand a year. 20 grand a year. Okay. So I was like, hearing stories about people making over $500,000 a year and still broke. And the reason why a person is broke is as you make more income is because you're a prime target for the banks. And so what the banks want you to do is do something called income segregation, segregate your income. So what that means is that your income comes into your checking account and then it gets split all over the place. How many debts do we have? One, two, three, four, five. No, 4, 5, 6, 7. So we got 7 debts, right? So it gets split all over the place, and we're making essentially minimum payments on everything. And what we're gonna do is put our savings here, right? That's what's seen as a responsible thing because that's what they encourage you to do. I mean, you look up on Google, should I get a savings account? Every big corporation, every big bank has an article on their website about why you need to save money, right? And instead of saving money, we're kind of going to do the exact opposite. So let's go ahead and copy these expenses and I'll show you how the velocity banking side works. This is going to be 0. And then this is going to be income minus expenses, right? And so instead of saving money, we're going to throw all of our money into the line of credit and move some debt into the line of credit. So I'm going to show you that I practice what I preach, although I don't give financial advice. You see this right here? I had a snapshot of a month where I had this much coming into my bank account. But you see the available balance? 0. Why is that? Because I threw all that money into a line of credit. I didn't have any savings, right? And so what we're gonna do is we're gonna have access to a $65,000 8% line of credit. And if you want to see a more realistic scenario where someone actually had a line of credit and it was filled to the max, click the join YouTube link button somewhere, wherever it is. It's only 99 cents. I'd leave the good stuff under a paywall. All right. So we're gonna go ahead and do that. And let's do this. So what we're gonna do is figure out which debts do we move to the line of credit. And cheat code, you start off with the high interest rate credit cards and short-term loans usually, right? And so I'm going to move these 2 credit cards. So this is, I think, 65,000. So let's go ahead and add them up, which is going to be $60,000, 660,000, right? And with that $60,000 into the line of credit, kind of think of it as like balance transfer. Guess what happens, right? These 2 go to 0. And we literally went from $93.17 to $2,014 of cash flow. Because how are we going to make that cash flow? We're going to dump all our money into the line of credit. The $6,900 into here, which satisfies the monthly payment. So you don't have to worry about that. And then you take your expenses out and then you rinse and repeat over and over again. So after every single month, the balance goes down by 2 grand. Okay. So we're going to go ahead and do that. And I'm going to do this and okay, minus 2014.00. So how do you determine what the next month's balance is? It's based on the previous month's balance, the accrued interest, and then you subtract your cash flow. All right, so now let's go ahead and calculate the interest, which is based on the average daily balance. We multiply this by the interest rate, so 0.08, and then we divide by 12, right? And so we see that for this month, it was about $400 of interest, okay? Oh, excuse me, I got a burp. I drink a lot of juice today. One of the things that I actually like to do is make a lot of fresh vegetable and carrot juices, and so I got a lot of liquids in my body now. Now, here's the thing. Okay, we got the goat, right? So I want to say this. When you're doing this, I want you to put a goat in every single month that you do this because you're going to be the greatest of all time, right? Just like ChatGPT told me, you are the greatest of all time. Okay. And let's go ahead and create more goats, right? And this is going to be the debt-free goat farm, not a factory farm, one of those nice organic free range farms. And then we see here in 34 months, it is all paid off. 34 months, it is all paid off. So 34 months. And how much in, all right, so 34 plus 25 and 60K, right? 60K, it's all paid off in 34 months. And now we got to tackle all these other loans, right? So let me go ahead and zoom out. So we got 6 loans here, 2 auto loans, 2 student loans, and a mortgage. Which one do we attack first? Do we attack these high interest rate loans, right? Or do we attack, should we leave this auto loan alone, or what do we do? It's confusing, right? And so that's why we have this loan calculator majigger right here. And the cool thing is that if you know these 3 factors, the original balance, the interest rate, and the term, it will automatically calculate the payment amount. And then if you use what you call the future value function, you could actually figure out, you type in a month, what the current balance is. So what's the current month right now? It's actually 34 months, right? And so it's 34, 34, 34, 34, 34. And so now these are all the balances of these loans. And how do I know which ones to pay off? Well, I'm going to use something called the cash flow index. So, if you listen to like certain people like Dave Ramsey says, "Oh, do the debt snowball," right? So, pay off this one and this 11 grand, and you'll feel good, right? I like to use a cash flow index because I want most bang for my buck, right? So why should I pay this 11 grand off first, even though it's a 3% interest rate? Well, it's because I get $449 in my cash flow. Why should I pay this 11 grand off later? Because then I only give $174 in my cash flow. So this cash flow index is just a simple formula of the current balance divided by the minimum monthly payment, or the monthly payment, when it comes to amortized loans, and then it gives you a number, and the lower the number, the more bang for your buck. And so we got these numbers in the 20s, the cash flow index. So what we do is we get these two, right? And we're going to pay them off. Okay, we're going to do that. And I'm going to do this. And I am going to go ahead and copy and paste this. All right. And I'm going to do that. And so now what we're going to do is move 27 grand, okay, 27 grand into the line of credit. So which is the 2 auto loans. And we're going to do that because we get the most bang for our buck in terms of cash flow. So plus 27968.68, right? And what's going to happen here? Let me zoom out. Let's go to our budget. Well, these 2 auto loans are now gone, right? So now it's 0, 0, right? And so now our cash flow is $3,000. Can you believe it? All right. Can you believe it? Oh my goodness. I can't believe it. All right. So now let's go ahead and get started. And then this is going to be 3156.26. And I'm going to copy and paste. And now in 43 months, okay, 43 months, we're going to figure out, we're going to figure out what the current balances of our other loans are. So we paid this one off, we paid this one off, and let me just do this. And now in 43, now we got to pay these off, right? And so here's the thing. The safest way to pay off debt, even though there's an interest rate gap, is using something called the chunking method. Sometimes you may have to pay more. Sometimes the amount that you pay, even though there's an interest rate difference, is going to be minimal. So, you might say, oh my goodness, why would you pay a 6% loan with the 8% line of credit, or maybe even a 3% loan? Well, one of the things that got us to the place that we were at is when we segregated our income. So one of the reasons why we would use a line of credit, even at 8%, is so that we don't segregate our income. It's a very important concept that I probably need to make another video on. So let's just do this because I'm going to be lazy for now. I'm going to move this 10 grand into the line of credit, okay? Because it's the smallest balance, and it has the lowest cash flow index, and it has the highest interest rate. So let's go ahead and move this 10 grand first. So I'm going to do this right here, and then this is going to be plus 10778.39, okay? And then what's our new cash flow? Well, this is now 0, our student loan. And so now our cash flow is $3,330.42. All right. And I'm going to do this. Copy and paste. So this is going to be 3330.42. And we see that in 2 months, whoa, student loan paid off. Amazing. So 46 months, the student loan, one of the student loan is paid off. Oh, did I screw up here? Yeah, that's 43 months. And then this is 40, was it 45? Oh, I really screwed up. Oh, well. Let's see, 43, yeah, 34. Okay, so 43 months. It's going to be 25 plus 16 plus 60 is 100K. All right, so now, all right, and then now we have the student loan, okay, and that was taken care of at month, what are we at? 46. 46 months. No, not this one, my bad. Right here. So this is 115K. Okay. And then now we have to tackle this student loan. So let's figure out 46 months what the balance is. So this is 0, 46, 46, and now it's 23 grand. So I'm going to demonstrate the chunking method in the mortgage because it's the most relevant. But when you do chunking, right? And if you don't know what it is, it's just moving parts of the loan into the line of credit and not the entire thing. So for example, let's say that I had a mortgage, this $206,000 mortgage. Does it make sense for me to move this $206,000 mortgage into a $206,000 8% line of credit? The answer is probably not. Excuse me. And the reason is that the mortgage, you pay this $200,000 off, you only get $1,000 or $1,100 of cash flow. And because you get such little cash flow, it doesn't get paid off as quickly, right? So the chunking method in many ways is superior, chopping up the pieces of the loan into the line of credit. Now, if you want to directly move your money 0% interest cash, you can do that too. The problem is that it segregates your income. So what we're trying to do is pay it off quickly, not segregate our income, and save the most interest as possible. Okay. Now let's go ahead and do this. And I'm just going to be lazy and move this into a line of credit too, because yeah, I am lazy. Okay. So I'm going to do this right here. I'm going to move this into a line of credit, copy paste right here. So this is the second student loan. And hopefully the student loans that you get do give you an ROI, even though nobody nobody really seems to care, right? Unless you go to be a doctor. And you know, if you're a doctor, then I'm proud of you. Though it's probably a toxic environment from what I've heard. In fact, I've been watching a lot of videos on YouTube about how much people hate nursing. Like, I probably need to do a reaction video on that. All right, so what's my cash flow now? It's $3,718.99. Not bad. Ooh, that's impressive. All right. Okay, so now let's go ahead and do this. So 3718.99. And I'm going to go ahead and copy and paste this. And then we see that in 53 months, all the loans except for the mortgage are gone. So this is going to be 115 plus 35. So 53 months. Wait, what was that? 53 months is 150K. All right, so let me go down and go here, 53 months, right? So I'm going to do this and type in 53 right here. And I'm going to do this. Now, one of the things that I talk about and why I say, wow, this chunking method is great is because like the interest rate kind of matters, but it really doesn't, right? And I'm going to demonstrate this with you with a 0% loan because let's just do this 0%, and then this is 0%. So you see that the monthly payment reduced from $1,100 to 611. Now, let's say somebody gave you a 0% 30-year mortgage, okay? And you did this chunking thing with the 8% line of credit. Most people would act like you are the dumbest person on earth. And I might say that to you as well if you had a 30-year 0% mortgage. So just do 611.11. Now, what is the worst that can happen to you by paying it off with the 8% line of credit? Well, obviously there was no interest to pay, so you're not going to save money, right? It's literally a 0% interest loan. But if you did this and you did it, you paid it off with the 8% line of credit, the worst that can happen to you is you overpay by 1,300 bucks. Okay. So when people say, "Oh my goodness, this is the worst thing ever," it's like, I don't even know what you're talking about. Okay. So let me just do this, and I'm going to show you what happens when you move the whole thing into a line of credit. Uh-oh, whoa, row 42 grand in interest. That's a no bueno. I'm not paying 42 grand extra interest on anything, okay? Um all right, like I'm not gonna do that. And so let me go back here and actually put in the actual details of the loan. So I think it's 5%, and what is it right here? It's 204,358.83. So 204,358.83. And then what's the payment amount? It is 1181.01. 1181.01. And let me just see if the deets are correct. And I'm gonna go in here and I'm going to show you this. And all right, so let me just show you here. 1181.01. So our expense is 2,000, income 6,900. And then here we see that it pays off in 3.9 years. Only 20 grand. And so even in a 5% mortgage, look how much interest we're going to pay off 30 years. And if we maximize our cash flow, then we can easily get rid of it and we'll be happy and have a good old time, right? So now this is going to be zero. And then how long is it going to take for us to pay off that debt? Well, it's 3.9 years plus 46 months. So it's 46 divided by 12 plus 3.9, which is 7.73 years. Oh my goodness. We are now debt free. 7.73 years. Now, I know that this person didn't pay it off in 2 years and 9 months. I get it, right? But it's still something to be, I don't want to say proud of, because it's just like you want to get to a point where it's so boring to you, or it's just like another day, like going to the moon. Never been. Okay. All right. Well, that's it. And so before I end today, you might be wondering, where did I get this velocity banking calculator from? And if you didn't know, you'll probably hear it for the 100th time, because this is all just a, how do I say this? Number one, I got two goals to this channel. I'm going to make some money by selling some educational packages. And number two, I'm trying to create a velocity banking cult. But I learned about velocity banking from an educational company called Renatus. And so I resell their education as an independent contracting marketer. So if you're interested in not only learning about velocity banking, but stepping up your real estate investing game and learning about all financial literacy and all that good stuff, well, click the Google form link below, because how do you think I learned all this stuff, right? And even buying property at a discount. You got to learn how to do that too. Okay. All right. Well, that's it for today, everybody. So again, velocity banking, pay off your mortgage under 3 years and act like it's normal. And a full disclosure, I've never been able to do a situation where I paid it off in under 3 years. Like every calculation has been about like 4 to 5 or above 3 years, right? So I'm not saying it's going to do that for you, but for me, that's what I did. And now I'm kind of a little bit bored by it. Good problems to have, right? Rich people problems. All right. Well, have a great day, everybody. And I'll see you on the next video.